In this video, I want to introduce one of the most powerful indicator on TradingView with the highest degree of accuracy. I will teach you two trading strategies based on this indicator, so make sure you watch this video until the end and let's get started. To add this amazing indicator to our chart, here we click on indicators and we search dynamic volume profile oscillator. This one, which is an editor specs indicator and written by Alpha in ATT. Alright, this is the indicator, and as you can see, it's added here below the chart. This indicator is an advanced indicator that has transformed volume analysis into an oscillator, and it is by making a dynamic volume profile and measuring price deviation from volume weighted levels of the price. And the result is this indicator that gives you excellent information about trend, momentum, and potential reversals in the market. This indicator has different components, which I explain them now and teach you how this indicator can be used for trading. Before we start, please give this video a like, and if you haven't subscribed to my channel, please subscribe and hit the bell so you get the notifications of my new videos. Alright, this line here is volume profile oscillator, and you can see that it changes color between blue and pink depending on the direction of the market. This volume profile oscillator moves above and below the center line, which is an adaptive center line, meaning it is not fixed, and depending on the volatility of the market, it also goes up or down, and this gives us a better and more accurate picture of the price movement in the market. In times that the oscillator crosses above the center line, it shows a shift to an upside momentum, which means we have greater upside momentum than downside momentum. So we can say the price is advancing. And in times that the oscillator crosses below the center line, it shows a shift to downside momentum, which means we have greater downside momentum than upside momentum. So we can say that the price is declining. Of course, not every signal is a good signal, and we can have these center line crossovers in the pullbacks. So when working with this indicator, we don't focus on these center line crossovers as starting of a new trend, but we look at them as momentum change within the longer term trend of the market, and we try to take the signals that are in the same direction with the current trend of the market. Later, I will teach you a trading strategy based on this, so make sure you watch this video until the end. Regardless of the position of the oscillator above or below the center line, the indicator also shows momentum changes in a shorter term perspective by the help of the color on the line, blue for bullish and pink for bearish. But we focus on the center line crossovers, which are better and more accurate for identifying momentum changes in the market. In this indicator, we have also upper zone and lower zone, with this line showing extreme level for upside movement of the price and this level showing extreme level for downside movement of the price. When the line goes above this line, I mean this extreme level, it is not necessarily a sign of overbought, and in many cases it can be extended and it can show strength in the upside movement of the price. So if you have a confirmed buy signal from other indicators in your trading strategy, having the oscillator line above the extreme level may confirm your signal and showing a strength in the upside momentum. But as I said, this can also be a sign for a potential reversal, because when the oscillator goes above the extreme level, depending on being extended or not extended, finally the upside momentum will lose strength and the price will go for a pullback. It can only be a pullback, or it can be a starting of a reversal. So any trading decision regarding reversal of the price when the oscillator goes above the extreme level needs more confirmation, and one perfect signal that you can get from this oscillator is divergence, which will give more probability that a reversal is going to happen. Let me show how you can trade based on divergence signal. In times that the price makes higher high but the oscillator makes lower high, exactly like what happened here, this is called bearish divergence, and it gives the possibility that the prior uptrend is ending and a reversal is probably going to happen. But we need more confirmation, because after divergence we can just have a pullback and then again further advancing of the price. One effective way is using price action analysis. In the divergence pattern between the two highs, we have a sewing low. We mark the low low and we wait for a candle to be closed below this low, because following the uptrend, when the last higher low is broken, it tells us that the structure of the prior uptrend is violated and there is a possibility for a reversal. In some cases, we have an instant reversal, and in other cases, the price may go to a trading range, like this case here, before establishing a new trend. By the way, if you're interested to learn price action trading, recently I published a book, The Art of Price Action Trading. The link is in the description and you can get it later if you want to take your trading to the next level. On the other hand, when the price makes lower low but the oscillator makes higher low, this is called bullish divergence, and it tells us that the downside momentum is weakening, and on the other hand, the upside momentum is gaining strength, and this gives the possibility for reversal. But as I mentioned earlier, we need more confirmation, because after the divergence, we can just have a pullback and then further decline of the price. In the divergence pattern between the two lows, we have a swing high, which we mark the high and we wait for the price to cross above this level, because following the downtrend, when this lower high is broken, it shows that the structure of the prior downtrend is violated and there is a possibility for a reversal to an uptrend. Alright, now let me teach you another strategy based on this indicator, which is actually a trend following strategy. In this trading strategy, we're going to use center line crossovers as buy-sell signals. So when the oscillator line crosses above the center line, it is a buy signal, and when the oscillator line crosses below the center line, it is a sell signal. But we want to take the signals that are in the same direction with the current trend of the market. For this purpose, we need to add another indicator. So here we click on indicators and we search MACD. This one, moving average convergence divergence, and we need to change its settings, so we go to the settings of MACD, and here for the fast length we set it at 100. For the slow length, we set it at 200, and for signal smoothing, we set it at 50. And then here in the style tab, we remove MACD line and signal line because we only need the histogram. Alright, this MACD with the special settings that we made will help us to identify the longer term trend of the market. And then by the help of this indicator, we will find trading opportunities in the same direction with the longer term trend of the market. When MACD histogram is green, it tells us that the trend is uptrend, so we should look for long position opportunities. So here in this indicator, we wait for the times that the oscillator line goes below the center line and then crosses above the center line. When the line is closed above the center line, here in MACD histogram, if the bar is dark green, we enter a trade. But if the bar is light green, we don't enter a trade, because when the MACD histogram is light green, it shows that the upside momentum is weakening. But when it is dark green, it tells us that the upside momentum is increasing. So we have a confirmed buy signal here, and we can enter a long position at this point with the stop loss below the previous swing low and profit target at 1.5 risk to reward ratio. On the other hand, when MACD histogram is below the center line and red, it shows that the market is trending down. So we should look for short position opportunities. In this indicator, we wait for the times that the oscillator line goes above the center line and then it crosses below the center line. When the line is closed below the center line, here in MACD histogram, the bar should be dark red. If it is light red, we don't enter a trade because this shows that the downside momentum is weakening. But when it is dark red, it shows that the downside momentum is increasing. So the signal here is confirmed and we can enter a short position at this point with the stop loss above the previous swing high and profit target at 1.5 risk to reward ratio. Please pay attention that although this trading strategy is very accurate, but it doesn't mean you will not encounter false signals. No, this is not possible, and you cannot have a trading strategy with 100% win rate. Losing positions are always part of the game, no matter how much accurate is your trading strategy or how much experience you have. So you need to manage your risk properly. There is a risk management strategy that is called 1% rule, and it's one of the best risk management strategies that you can use. I have a complete guide on this. The link is also placed in the description description, and I highly recommend you to watch it because without a proper risk management strategy, you cannot become a consistently profitable trader. Alright, that's it. Thank you for watching this video. If you have any questions, feel free to ask and leave a comment for me. I'll answer your questions as soon as possible. If you haven't subscribed to my channel, please subscribe and hit the bell so you get the notifications of my new videos. See you guys in next video and good luck with your trading.